we all know taxes, right? That yearly thing, gotta pay them. But ever wonder how the big guys, the companies raking in billions, handle that?
Yeah, it's a whole different ballgame.
Turns out they've got some tricks, and today we're going deep on one that's surprisingly common, timing investments just right to, well, minimize those taxes.
Like planning a vacation, finding that cheap flight. But instead of saving a few hundred, we're talking millions for these companies.
Okay, gotta hear more about this. We've got this paper, super insightful, Tax Policy and Abnormal Investment Behavior by Qiping and Eric Zwick.
Solid credentials.
Yeah, University of Illinois in Chicago, so serious number crunching going on.
And they found something interesting. Companies, they tend to make huge purchases like buildings, equipment, all that capital stuff, mostly in the fourth quarter of their fiscal year.
End of year. Gotta spend it all, right? But it's not just holiday bonuses or anything. The paper says on average, they spend a whopping 36% more in that fourth quarter compared to any other. Imagine cramming all your shopping into December.
Exactly. And it's not new either. This has been consistent, like decades consistent, from 84 to 2016. And it's not just an American thing. They saw the same trend across 24 different countries.
So definitely not just using up leftover budget money then. They even looked at companies that changed their fiscal year end. And guess what? The spending spike moved right along with it.
Like clockwork. Tells you something's tied to that specific timing. And that's where it gets interesting. Depreciation and tax strategy.
Depreciation. Sounds a little dry, but I have a feeling it's key here.
It's actually pretty simple. Think of it this way. You buy a laptop for your business, let's say. You don't expect it to last forever.
Definitely not.
Depreciation is how companies account for that wear and tear. They get a tax break spread out over the useful life of the asset as it loses value.
Getting old discount for businesses, kind of.
Exactly. Now, here comes the strategy part. U.S. tax code, it's got this thing called MCRS, Modified Accelerated Cost Recovery System. Right. But the important bit is the half-year convention. Don't get lost in the jargon, basically. Even if a company buys something in the last quarter, December 31st even, they can claim a deduction for half the year.
Wait, so it's like a bonus just for timing your shopping right? Which I got that deal on holiday gifts?
Right. And this is especially juicy for companies making good money, positive taxable income. They want to lower their tax bill now, not later.
Cash in hand. Makes sense. And the research backs that up. Companies with positive taxable income, much bigger investment spikes in Q4, like 7 to 12% higher than those in the red, putting that half-year convention to work.
Exactly. Like waiting till the last minute to file your taxes. But instead of receipts, they're moving billions around.
Yeah.
4D chess with their finances.
But here's where it gets even juicier, right? It's not just about dodging taxes for that 1 year. This option value thing, that's where it gets interesting.
Definitely. It's like you buy a concert ticket way in advance.
A year out, you never know.
Exactly. You might be busy, something else comes up. But having that ticket, it gives you the option.
So are companies buying themselves options with these late investments? Flexibility.
Exactly. They're saying, let's see how the year shakes out. Big profits, boom, big purchase. Take the deduction, lower the tax bill. Bad year. We haven't committed to anything.
Having your cake and eating it too, tax-wise anyway.
Precisely. And the research, it backs this up. Companies with consistently high profits, but not a lot of ups and downs, the steady earners, they actually had even bigger spikes in Q4 spending.
So not reacting to a single year, it's like bigger picture strategy.
Absolutely. Long game with their taxes.
Yeah.
Now you might be thinking, what about those companies struggling? The ones barely scraping by.
Yeah, you'd think they wouldn't have cash lying around for these big end-of-year sprees.
And that's where it gets really interesting. The research found that companies in a tight spot, financially constrained, they're actually more sensitive to these tax incentives.
Wait, really? So even if they're short on cash, they still make those big investments late in the year?
Exactly. Because when every dollar matters, saving money now through those deductions, it becomes even more crucial.
Double-edged sword then. Companies rolling in it, they're being strategic. Companies on a budget, they need that tax break.
And here's the kicker. It's not just shifting money around. The research debunked that whole thing about companies moving investments from other quarters to Q4.
So not just robbing Peter to pay Paul.
Nope. Investment levels, they stay high for years after a spike, especially for the companies with positive taxable income at the time.
Wow. So one decision has ripple effects for years. Okay, so that's how individual companies play the game. But what about the big picture? Zoom out. What happens when everyone's doing this at the same time?
Imagine this. All your friends decide to buy new cars, but only on Black Friday.
Chaos.
Dealerships are swamped, cars run low, suddenly financing matters more.
Yeah.
It's similar with these spending spikes.
Creates a ripple effect. The whole economy feels it.
Exactly. Think of the companies supplying the big stuff. Machinery, equipment. They see this huge surge in demand, Q4, because everyone's trying to grab those tax benefits.
So they're scrambling to keep up. Do prices go up? Are they taking advantage?
Surprisingly, no. Research suggests demand spikes, but prices stay pretty steady. What they do find is these supplier companies, they start stockpiling inventory, getting ready for that end-of-year rush.
Makes sense. Don't want to miss out on all those orders. So it's not just the companies BUing, it's the whole chain reacting.
Exactly. Even the lending market gets in on it. Small business loans, they spike in December too, reflecting that need for financing to support all these late-year purchases.
So this little quirk in the tax code, this half-year convention, it's like a butterfly effect, impacting equipment makers, banks, the whole shebang.
Highlights how interconnected everything is. And it brings up a big question.
Makes you think about those who write the tax code, right?
Absolutely, yeah. If we know companies are using this, timing their investments, how do we encourage that, investment in general, but without giving loopholes only the big guys can use?
Right. Got to encourage growth, but keep it fair. Tricky balance.
For sure. Policymakers are always wrestling with that one.
This whole deep dive, I'm seeing taxes in a new light.
Right.
Little details having huge impacts. Who knew?
It's amazing, right? Makes you wonder, what other incentives are hidden in there? What other moves are companies making that we don't even see?
A whole secret strategy game, but with billions of dollars at stake.
In a way, it is. And getting this, understanding it, it's valuable. Investor, business owner, or just someone trying to, make sense of the world, it matters.
Couldn't agree more. Goes to show always something new to learn, even about taxes.
Always another layer to uncover.
That's what we love, right? The deep dive. Come for the fun facts, stay for the big questions.
Exactly. And hey, maybe this gets people thinking. How do we make a tax system that's fair, but still encourages the kind of investment that helps everyone?
Now that's worth thinking about. Thanks for joining us on this deep dive into the world of, taxes and investment strategy. Until next time, keep exploring, keep questioning, keep diving deep.